Hello. So today we're going to continue discussing the financial information, and today we're going to specifically talk about a very important statement which is called income statement. We're going to talk about balance sheet and some tools for analysis of accounts and look at some real examples of accounts. Okay? Now, the starting point, what is income statement? Income statement is the company's document that shows profits and losses of the company. And by the way, it's also well known as profit and loss statement, where the revenue, the different types of profits, and different costs are shown in a specific and consistent way. Now, there are some formats that make sure that every company actually lays out the income statement in a specific way. For example, it can be IFRS, or it can be non-GAAP, and other formats that are well known in worldwide. Now, okay, so we said that this is a document that keeps transactions of all the profits and losses within the company, but then the question is why businesses need to keep accounting records. Well, if you're a public limited company, then whether the investors will be keen on invest further or not, whether your shares would be on demand and therefore the price will go up or down, will actually depend on how clearly you actually reflect in your profit and losses. So it's super important for public limited companies as well as private limited companies and even sole traders, because you want to know exactly what's happening within your company. Now, we also know that profits may not always be the same as the cash from the previous lecture. Do you know why? Because as you do remember, sometimes you may actually sell your product or service on credit, meaning that the cash will not be instantly be transacted in this month, but maybe it will be sent next month or so. So therefore, there is a thing that is called receivables. Okay, we're going to talk about receivables more and show it in our income statements and balance sheet. But receivables are those amount of money and the cash that wasn't received yet, and it's hopefully going to be received. Okay, well, this is the payment which is made by debtors. The debtors that those people, those clients that owe you, okay, they call debtors. Well, profit is important. I think it's super important because it actually shows how efficient your company is in adding the value. Well, and ultimately you're not interested in the revenue, but at the end of the day you're more interested in your profit, because this is the amount of money usually that you are left over and you can actually use for further investments or your own personal use. Now, so far we have discussed only the general and very broad concept as profit, but actually in an income statement and profit and loss statement, there are even three types of the profits. So the first one is called gross profit, the second one is called net profit, and actually there is even more that is called profit after taxes. It's specifically called profit after taxes. And lastly, there is a retained profit. Okay, we're going to actually lay out and show it schematically what's the difference between them and discuss it from time to time in the context of a specific examples. Okay. Well, what does it contain? That's the whole topic of today's lecture. We're going to talk about it in details. Now, what do we need? Income statement, we said, okay, it ultimately reflects how efficient we are, what's the profit left, and also it's about comparison. It's about comparing with the last year. So are we actually improving compared to the last year? And if you do remember, businesses, they set up their business objectives, and they also, the profit is one of the milestones, is one of the metrics that businesses use to compare whether they're improving and whether they're approaching their business objectives or not. Is it lowering? Is it increasing? It's a super important question, isn't it? That's why you have to keep track of it and keep track and save the historical data on your income statement. Now, is it higher or lower to similar businesses? Industry-wide benchmark? Okay, what is industry-wide benchmark? Now, in this case, we will talk about some multiples, some ratios, because if you do remember, there is no company that has exactly the same profit or exactly the same revenue. Just the probability of two different companies, okay, operating independently to have exactly the same figures and numbers is just minimal. That's why even similar sized businesses will ultimately have different numbers and figures. And then the question is, how do we actually compare these two businesses, or how do we compare ourselves, our businesses, with our rivals? In this case, multiples are very important metrics to use. This is actually a ratio. Okay, we're going to talk about this in detail. And usually companies and investors, they tend to compare your efficiency, your multiple, okay, your margin with other companies or with industry-wide benchmark or industry-wide norm or average. That's why it's so important. Now, if it's lower, then that means that we're doing something wrong. Either we are spending too much, or we're not very good at selling, or, well, ultimately that's it, okay? Or the pricing strategy isn't appropriate. If we are making a loss, then the question is by the managers to ask, is it a short-term or is it a long-term problem? Now, if we talk about this pandemic these days, where the businesses, they stopped, okay? So hopefully this is going to be a short-term thing, a short-term loss, because hopefully after several months it will go down, and then the business will start again working and operating and functioning, and then hopefully this is going to be a short-term problem. But sometimes there is a long-term problems. If the demand, for example, you used to produce a piece of technology that from day to day people just don't want. It's exhausted. It's not up to date. So that means if you're still producing mobile phones using these buttons, then this might be actually a long-term problem, because in a long run, the customers may not actually want your product. Okay, so this can be a long-term problem. And then the question is it only your problem, or is it your rival's problem as well? Is it industry-wide problem? Sometimes the economy might do well, but your industry may not go actually well because of various reasons. So therefore, you want to actually compare whether it's your business's problem only, or is it an industry-wide problem. And we need to think about what other decisions needs to be made. They need to be made so that we actually turn our losses into profits. Well, this is a big deal, isn't it? And it's very individual. There isn't like a one formula for every single company. But income statement actually allows you to keep track and monitor how well you're doing in a profit and loss. Good, so let's talk about gross profit. So the first profit is called the gross profit. The gross profit is equal to sales revenue. So for example, I'm going to give you different examples. So for example, you've sold something out, and then you actually spent some money to produce this product. So here we're going to introduce the term that is called cost of goods sold, also known as COGS. Okay, it's a cost of sales. Sometimes it's also known as cost of sales, but generally it's cost of goods sold. Now, let me give an example. If you're manufacturing, for example, plates, okay, let's say you're manufacturing plates. Now, what is the cost of goods sold for this particular plate per item? This is going to be obviously the materials costs, because you're actually purchasing it from somewhere, from the external. This might be some direct costs that might be associated with the delivery of this one, or the direct labor cost that your engineers, your workers, your employees that are directly involved in a manufacturing of this piece of plate. Okay, so the cost of goods sold, usually they're also known as direct costs that are associated with the production or providing a service of this particular item. Good. So we're going to give you some examples also. Now, cost of goods sold is not necessarily the same as total value of goods bought by the business. Again, it might be same, it may not be the same in the case of the manufacturing the plate. Obviously, you're buying the materials, and the materials are not the only costs, which will be included to the cost of goods sold, because you have direct labor costs and some manufacturing and operating costs. I mean, not business operation, but manufacturing operation, the processing costs. Whereas if you're a retailer, let's say that I'm a big supermarket, and I'm actually buying it from the manufacturer and just reselling it in my supermarkets. In this particular case, the cost of goods sold will be equal to the cost of a manufacturer that actually with whom I had a deal with, and then this may also include some delivery costs. Okay, let's take a look at some example. So there is a wholesaler. A wholesaler is a retailer, kind of, but it's a bigger one. So wholesaler usually deals with the smaller retailers, okay? Now let's say that these guys, they do not produce, they just buy and sell. They're buying a can of drink at the price of $1, okay? And then resells it at $2. Now, at the beginning, they actually had 200 cans in their stocks. So this is inventory, запасы, isn't it? And it bought 1,500 cans. And at the end of the year, they were left over with 300 cans of inventory. Now, this is pretty basic example. This is pretty simple example, and let's discuss it quite quickly. Now, how many cans did the business sell during the year? I think you can work it out. So we began with 200 plus 1,500, and then we left over with 300. That means we were able to sell 1,400 cans, isn't it? What was the cost to the business of the goods sold? Now, the cost of the business of this particular wholesaler is going to be $1 multiplied by 1,400 cans that was eventually sold out. That means that it's equal to $1,400 of the cost of goods sold. So in your income statement or profit and loss statement, you're gonna use $1,400 as a cost of goods sold. Okay. Now, if we do calculate the sales revenue, we know that it's $2 per can, and then we also know that we've sold out 1,400. And we can work out that in this particular example, the sales revenue is equal to 2,800, and the difference is going to be our gross profit. So hopefully it's now clear what is gross profit. Now let's take a look at this particular another example. So here we've actually laid out a very simplified version of an income statement for academic purposes only, but still in this particular lecture we're going to show you the real income statement by Amazon. Okay, so for academic purposes we sometimes simplify and use some models. So but however, it's very representative and it shows the basic concept anyway. Now the gross profit, it's already calculated here. Now what is non-trading income? Sometimes in income statements of companies you can actually see operating income, which is sales revenue, okay, and non-operating income, or also known as non-trading income. What is this? Now, this one could be associated with revenue, with earnings of a company, not made by the direct operational, well, not made by the sales of the products and services, but just, for example, depositing the money in a bank and generating some earnings as interest rates, or buying some stocks of other companies in a public markets, or buying the bonds of governments or debentures, if you do remember, of other companies. So this is generally non-trading income. So in this particular case, $5,000 is non-trading income, but it's still income. That's why we have to take it into account. And then there are some other expenses like wages and salaries. Electricity, sometimes students, by the way, ask what's the difference between wage and salary. The wage usually is, well, commonly known as paid weekly basis. Salary is paid on a monthly basis. That's the difference. Electricity, rent, depreciation. Now, what is depreciation? Depreciation also sometimes is used as amortization. We're going to talk about it in a balance sheet in particular. So this is a cost that business needs to take into account, for example, when you're using an asset like an equipment, a physical and tangible asset like an equipment. Now, we know that when you purchase an equipment, let's say the cost would be $1 million. And obviously, after 1 year time, it will not cost $1 million. It will depreciate. It will devalue. That means that we have to take that into account. There are different methods of calculating to what extent it will devalue and depreciate, but we just need to take it into account because the equipment, the tangible asset, the physical asset, would actually eventually lose some of the value as time goes. And some other expenses. So what's the difference? Here in this particular slide, I'm going to talk about the difference between gross profit and the net profit. The gross profit, we know that it's revenue minus cost of goods sold. And then there are some other expenses. We call it non-indirect expenses, okay? Which may include wages, salaries, which may, by the way, include the interest paid to the bank if you have a loan. So all these indirect, which are not related to the operations directly, expenses are going to be called indirect expenses, indirect costs. But you have to take that into account because you obviously have them and you incur them every single month. That is why we have to take it into account. We have to subtract it from the gross profit, and at the end you will have the net profit. Now the question is net profit the final profit that you can actually have as a business owner? Unfortunately not. There are some other things that you still have to pay off. Now, in this schematic, we've actually shown you how this revenue goes to the gross profit and then go to the net profit and then go to the retained profit. Now, we're so far so clear that the gross profit is this. Now, there are some other expenses, as I said before, indirect expenses, including interests paid to the bank, and then you're left over with the net profit. And hold on a sec, there is actually tax that needs to be paid to the government. Now, in Kazakhstan, depending on which regime you're choosing for paying taxes, for the taxation regime, these might be different. Now, if you're working, for example, as a private limited company, ТОО, по общеустановленному режиму, then in this case, you're going to pay 20% of the net profit, okay? But if you're actually working on упрощенный режим, okay, then you're going to pay only 1.5% of your sales revenue. And you can actually take that into account even here. Now, once you deducted the taxes, there are some dividends. So the shareholders, the business owners, should actually benefit something. And then it's up to the company to decide how much they will pay as dividends. Now you can actually, there isn't a solid rule. There isn't such a thing that you have to pay 50%, 20%, or even 100%. You can pay any amount. So it's something that you have to mutually agree with each other, okay? And it can really vary from company to company. But ultimately, you will pay off some dividends. And then this retained profit is accumulated profit. It's retained in a company for further expansion, for further investments, or just secure yourself from some crisis like nowadays. So the wise companies, they always have this buffer of security. They always have this some money in their pockets so that they can actually pay their liabilities, обязательства, liabilities to the employees, to the other parties. Okay, so it's very wise to have some retained profit untouched because things may go wrong. Okay, now this is how it looks like. So we've laid out it in this way. So the company is monitoring the progress from 2012 and 2013, and as you can see, it subtract, and then you have some retained profit. Now, actually, here, can you have a negative figure? Yes, you can. And this is called the loss. The net profit can be negative. But the good news is, if you have a negative profit, the corporate tax, in this particular 20% case, will not be paid off. Okay, this is the good news. But if you're paying 1.5% and it's uпрощенный режим, then you will have to pay it anyway, even if you're incurring losses. Okay, this is a summarized version of what we just discussed. This is Amazon's income statement. So if you can see, the terminology slightly differs. So this is a slightly problem in finances because different people use the same thing. They do mean the same thing using the various terminology. So for example, sometimes earnings can be used as revenue. Sales can be used as revenue. Gross profit is gross profit, usually operating income. So there are various ways of calling the same things, but at the end of the day, this is the same thing, and the logic doesn't change a lot. So I think Amazon is operating with American standards, IFRS, not IFRS, I guess. I think it's operating with non-GAAP standards, but anyway, they have a lot of similarities, just a small differences in nuances. So as you can see, this Amazon company in 2018, in December 31st, they had net income, which is net profit. It's not even retained profit, it's net profit, shown as positive, okay? And it's 10 billion, by the way. Good. So I'm going to continue in the next video. We're going to talk about balance sheet, okay?